All right, here we go with where we picked up. We're going to pick up right where we left off on Friday. On Friday, I was hemming and hawing about what we wanted to do, what we didn't want to do. I have made my decision. Right as of now, these if time permits bits, I am going to get rid of. Those would be great if we have some time to kill here right before the test on Friday. But as of now, we'll finish what we started with problem A. You'll of course do the problem B version of that. Under problem 5.3a, remember there is the owner's equity statement, there is the classified balance sheet. It's just that we are exclusively going to do the multi-step income statement. And again, that'd be down here as well. So right now, let's pick right up where we left off. Under problem 5.1a. Because we're doing a lot of purchasing of inventory and then turning around and selling it, this was really nice, a nice set of notes that if you need review on that, that's there. But here's what we had gotten done so far. Again, I'm on page 258 for this. Looks like on June 1st, we purchased books on account, free for us because it says FOB destination. We turned around and sold books to Reading Rainbow. I see the word sold, so that automatically tells me that we've got 2 transactions. Then we turned around and returned some of the books that we bought from Klein, and then we paid Klein, less the discount because it was in that 210 and 30 credit terms. We're going to move on now to right where that's what we did on Friday. Now we're going to work on continuing and finishing this problem. So I'm on, again, page 258. I'm reading the June 15th transaction. It says June 15th, received payment in full from Reading Rainbow. You might say, well, where did Reading Rainbow come into play? Well, back on June 3rd, we sold to them. Well, on June 15th, they're paying us. The first thing I want to look at is, did they pay within our 210 and 30? Well, on June 3rd, they bought from us. On June 15th, they paid us. So it looks like they did not hit that deadline within 10 days. So we're going to just take their full payment of $2,500. And cash will go up as a result. And what they owe us is wiped out. The reason we didn't offer a discount from back here on that purchase is they didn't pay us in time. They had until the 13th. They paid us on the 15th. Moving on to June 17th. Sold. I see the word sold. I automatically know it's going to be 2 transactions. Sold books on account to Blanco Books for $1,800. The cost of the book sold was $1,080. I can already tell we better start finding cheaper books, but nonetheless, let's put the 2 transactions in. Let's first get the revenue. It must read on account. Yes, on account. So AR is going to go up by the 1,800. Sales revenue is going to go up by the 1,800. Woohoo, we sold stuff. They didn't pay us cash, rather it was AR. That stuff wasn't free though, so that cost of goods sold will be debited. Again, that's a little bit of a contra revenue account in nature because it offsets that credit of $1,800. And the stuff that's gonzo is that inventory of $1,800. Again, that's what we paid. That was our cost of goods sold. Moving over to page 259 in the book, purchase books on account for $1,500 from Dietz Publishers. I see some credit terms. They're different than what we're used to. And it says FOB destination. So it's free shipping for us. The appropriate party also made a cash payment of $50. And again, the book's just trying to confuse you there. If it's FOB meaning free for who? And in this case, it's free for us, the destination. Purchase the books for $1,500. So we gained inventory of $1,500. We have an accounts payable. It wasn't cash. We charged it on account. Take a look at the terms this time. It's $215. They must really like their customers. They're going to offer a 15% discount if paid with, or excuse me, a 2% discount, but they're going to give us 15 days to do it. On the 24th, received payment in full from Blanco. So what we need to do is go back and find out when we sold the Blanco. On the 17th, it's now the 24th. Our credit terms are 210 and 30, and it appears they paid within that discount period. We received cash. Cash is going to be up. You might say, well, why not the $1,800? Well, we offered that 2% discount because remember, our terms are 210 and 30, and they paid within that 10-day time period. So we're going to offer them a sales discount. Again, that's another contra revenue account. It's offsetting our revenue that originally came in. And now AR no longer owes that $1,800 balance. And you might say, where is that coming from again? Up in here is when we sold to them, and now they're paying their bill. Remember, don't get confused by the sales discount versus when it's us purchasing and getting a discount. It's masked in inventory. When we are selling, we have revenue and contra. When we're purchasing, it all is masked under inventory. And I know that's confusing, and just the more you do it, the better you'll feel about it. What's going on the next date? 26, we paid Dietz Publishers in full, less their discount. Dietz had a really nice long time period. Remember, if you go back up to the 20th, it was $215 and 30. We just happened to pay it off 6 days later. So when I see paid, cash is going to go down. It's basically reverse of what we just did when someone paid us. We are paying someone else. So that, as a result, you'll see AP go down, cash go down, and inventory go down. Again, it's very much opposite of what just happened in the 26th, or from the 26th to the 24th. It's opposite. It's just that it's going back to this. When we bought stuff, in this case, we bought from Dietz Publishers. When we bought stuff, we got the stuff, but when we paid early and got a discount, you'll see that payment actually devalue our inventory. On the 28th, sold, bam, bam, 2 transactions. Sold books on account to Ready Bookstore for $1,400. The cost of the books was $850. So if we sell to someone on account, you're going to see that asset increase. Again, that's an asset because we own the right to eventually getting paid. Sales revenue went up, and those numbers are, I know my recording is covering that. Those numbers are $1,400. Looks like we've got a better buyer here in this case because we're getting substantially lower cost of goods sold. Remember, cost of goods sold is going up, and we're going to see a decrease in inventory simply because the books are gone. If we sell them, they're gone. That asset's gone. And then remember, this is that contra revenue nature-based account because if sales revenue normally has a credit balance of, in this case, $1,400, that wasn't free, and so you'll see a contra revenue technically in there to offset the revenue because it wasn't free. Last transaction, we've made it. Granted Ready Bookstore $120 credit for the books returned, costing $72. So back up on the 28th, we sold stuff, and they quickly, 2 days later, decided to return. It doesn't sound like they're defective. They just decided to return them. Because we have inventory coming back to us, and it originally was based in a sale-based account, you will see 2 transactions there. We first need to lower what is owed because we returned something. excuse me, they returned something. My apologies there. They returned the stuff. So the stuff's back. They no longer owe as much. Cost of goods sold went down because we have it back, so it's technically not a cost at this point. And sales returns and allowances is contradicting our revenue. I want to say that all again. I had a little distraction over here. Back on the 28th, we sold books. Now on the 30th, they, meaning Ready Bookstore, was returning them. The reason it's times 2 is because we're getting inventory back. We first say sales returns and allowances because it's a contra revenue account. We originally sold it for a 120. AR doesn't owe us that anymore because they brought them back. But we have the revenue, or we have the inventory back, offsetting cost of goods sold. That's where problem 5.1a ends. It's my preference that we roll right into 5.3a next, and then you'll have time to do your problem B set stuff on your own. I'm going to pause the recording. You won't notice that, but I'm going to hit pause real quickly. Okay, as we join back, I know again you didn't feel that much of a pause, but I just took a minute to get things organized in the classroom. We are going to move on to problem 5.3a. I'm looking at the bottom of page 259 in the book. You'll notice it reads, the Deluxe store is located in Midtown Madison. During the past several years, net income has been declining because of suburban shopping centers. At the end of the company's fiscal year on November 30th, 2014, the following accounts prepared into trial balances. And if you flip over to page 260, you'll see lists of accounts with both unadjusted and adjusted balances. We really won't be rolling with the unadjusted balances. Rather, everything that's in adjusted is what we'll be using to prepare the financial statement. And in the instructions in that follow, it reads, prepare a multi-step income statement, journalize the adjusting and closing entries. We won't be doing B and C. And even within an A, we're not going to do the owner's equity statement, nor will we do the classified balance sheet. So if we start looking at lists of accounts, there's some there that don't appear on the income statement. For example, all of the assets. And so lightly with your pencils, if you want to, on page 260 in your book, lightly cross off the stuff that we're not going to need on the income statement. Accounts payable and receivable, those are both assets. Excuse me, accounts payable, liability, accounts receivable and asset, those show up on the balance sheet, so lightly cross those off. As well as accumulated depreciation and cash. Those show up on the balance sheet. And since we're not using that for this problem, you can cross them off. Cost of goods sold, of course, is an offset to revenue. Leave that one. Freight out, which we now know the difference between freight in and freight out. Freight out is considered an expense that would show up on the income statement. You can lightly cross off equipment. Depreciation expense. Insurance expense. Those are going to show up on the income statement. Please leave those. I see 2 curveballs, or what we've put in the riffraff section. Interest expense, interest revenue. They are going to show up on the income statement, but I'd like you to star those. We'll come back to those. Inventory. Although this chapter is all about inventory, inventory is an asset, and that would show up on the balance sheet. You can cross that off. Let's go over to the other column. Notes payable, capital, drawings, and prepaid insurance all show up on the balance sheet. You can lightly cross those off. Property tax expense. Expense shows up on the income statement versus property tax payable shows up on the balance sheet. So cross that one off. And it looks like we've got expense, expense, revenue, expense. So rent expense, salaries and wages expense, sales revenue, sales commissions expense, all would show up on the income statement. Whereas that payable, balance sheet, sales returns and allowances, income statement. And finally, that last expense, income statement. So I think it's important we just made sure to know what's going to even show up on the income statement, and then now it's our job to put it in the correct spot. We know there's sales revenue, operating expenses, And then what we learned on Friday, that little riffraff section. Remember what gets put down in that riffraff section, other revenues, other expenses. Things that don't impact the day-to-day livelihood of the business will show up down there. I used Willys as an example on Friday. Willys is not in the business of selling shopping carts. However, if they sell some shopping carts because they got new ones, that would be considered other revenue, not the day-to-day revenue like selling cans of corn and bakery and dairy goods. So just know that this problem will have some other revenue and other expenses. Let's get rolling. Our first main heading is sales revenue, money in. If you look on that top of page 260, there is some money in. It's called sales revenue of $700,000. We know there's going to be way more chopping blocks that chop away at that $700,000. I'm going to be honest, our net income is actually going to be $29,100. So that's a significant amount of chopping that offsets all that money in. We know there's really three things that deduct from sales, and let's take that in steps. Less sales returns and allowances. Another one that doesn't happen to show up here, but I think it's worth writing just as a note to, less sales discounts. It's just that we don't have that one on this problem. Our first hoop, net sales of $692,000. You're already seeing that 700 be chopped up a bit. At this point, we can say less cost of goods sold. To equal our next one, gross profit. Remember, net sales is impacted by sales returns and allowances and sales discounts. Gross profit is impacted by COGS. You might see that everything's happening over in the right column there because there hasn't been a substantial amount of math needed. You'll see that come sooner. This really breaks into all the money in. Now let's start focusing on the money out. The heading for that would be operating expenses. And you'll list anything that has the word expense by it. We know that we should really add the word expense to freight out. Sydney did a nice job explaining why freight out is an expense, whereas freight in is masked as inventory on Friday. So thank you, Sydney, again. You might argue what's the order here? It doesn't appear to be in alphabetic order. On my answer key, it appears to be in order of largest to smallest balance and value. You'll also notice we're on that left column because we have a lot of math. That will end up being total operating expenses that we put that total in that right column. I know this is taking a while to write, so I will go ahead and pause and give you time to update your notes. At this point, had we not had those two riffraff accounts, we would land at a net income number. But because we have a little bit of expense and a little bit of revenue coming in and out, we have to pause, and instead of writing net income right now, you're going to write income from operations. This is the income from us doing business. Money in minus money out. Those two little curveballs there, though, at the top of page 260, we had interest expense and we had interest revenue. We know that that is not directly tied to us selling whatever we sell at the deluxe store. So then what happens is it gets itemized down here as other revenue and gains and other expenses and losses. Take time to plug those in. again, we see a plus 8,000 and a minus 6,400. It looks like we have money coming in the form of interest, but we also have money going out in the form of interest. The reason you know is revenue and expense. The big difference here as we get into this riffraff or stuff that really money in and money out that doesn't pertain to operations of business is how this is worded. We very much are used to putting net income, what I just boxed out in green. Net income is not going to actually show up until the bottom because we did have some money in and money out come through here. So we had this gross profit minus the total expenses to equal the income from operation. The reason we are going to plus that $1,600 difference is because we had more other revenue than we had expenses. So 8,000 minus 6,400 is a difference of that plus 1,600. Which leads us to that final net income number of $29,100. Are any of you sweating yet? Because that's a lot of number crunching and a lot of listening. I think it's important that at this point we revisit exactly what I'm looking for in homework. That if time permits, doesn't need to be done. That's going to be an awesome study tool later in the week. We've done our journal entries. It's important that you do the B set of the journal entries. We've done just the multi-step income statement. It's important that you do just that same version in 5.3b. If you page ahead, problem 5.1b can be found on page 263. 5.3b is exclusively on 264. And very much like the A set, go through, lightly cross off the accounts you don't need. Pay attention if there's riffraff, and I can already tell there is. We've got interest expense and we've got interest revenue. If your numbers aren't shaking out correctly, perhaps there's more riffraff, and all you got to do is go back in the chapter and reread what constitutes other revenue and other expenses. You will notice that they've given you your net income number out there on the left margin. It looks like the net income for your multi-step income statement will be $129,100. Don't forget the layout. We've got sales revenue, net sales, and gross profit are two hoops. We've got operating expenses and their total, and it appears that you're not going to put net income here. Rather, it's going to be income from operations to do the other revenue, other expenses, then to get your net income, when, of course, you're working on the B version of this. I am going to just give you a little preview. Showing you that here are some of your key numbers. I thank you for being attentive today. Thanks, Mr. Beyer, for helping facilitate, and of course, Ashley, for getting the video going. It's not easy doing it this way. It's really awkward for me as I stare out at empty computers. But I hope that with my absence, this is a really nice tool that I can still be here in a viral nature. So we'll see you tomorrow. I will be looking at problem B stuff as you walk in, and we'll also get rolling with our practice test. Have a great rest of your day.